Today, you will learn about the all-time high protocol, which essentially is how you can go about trading instruments that consistently reach all-time highs. For example, ES and NASDAQ, the indices in general, or the metals, so gold and silver, or even stocks. Now, you're going to learn this in a couple of steps. The first thing that is important to understand, I refer to these instruments as all-time high instruments. And the reason why that is, instruments that sooner or later, oftentimes are going to reach all-time highs again, are what I call all-time high instruments. And all-time high instruments are arguably one of the easiest instruments that you can trade. So for example, ES and NASDAQ is actually very straightforward trading the all-time high protocol. It's quite simple. So all the all-time high protocol really comes down to is looking for a reason to buy again. You could even invert it. So for example, if you find an instrument that is consistently reaching all-time lows, then you have an all-time low protocol. And the reason why these things are so simple, quite straightforward, and easy to trade, in my opinion, is because you're working with a very clear buy. So for example, if you were to compare, let's say, NASDAQ and ES actually with a Forex, you'll notice majority of the time in Forex, we are just consolidating. So we don't really have a very clear direction. And even if we have a very clear direction, it's not like we are going to continue higher or continue lower forever. So oftentimes, what you're trading, for example, euro, US dollar, you're trading two economies against each other, and two economies against each other, it's competitive, of course. So they are consistently going to compete with one another. So that also means that, for example, euro, US dollar might continue higher because the euro is stronger, but next week, then the US dollar is stronger again. So there's no clearly defined bias in Forex, or again, not just Forex, right? This also comes down to a lot of other instruments as well. Unless you are looking at the US dollar against a third world country currency, then you also have these all-time high protocols. But again, then you're also trading with horrible spread, etc., etc. So in my opinion, the instruments that are by far the best to day trade, swing trade, even scalp, indices, futures. So that is ES, that is NASDAQ. You'll have quite a simple time overall, quite a good time even. And the reason why this is because you have somewhat of a predefined bias. So there's actually a statistic. I'm not entirely sure, so I'm doing this from the top of my head. I'm not entirely sure what the statistic is, but I believe the indices in general have a 55% or 60%, something around that, predefined bias. So that means they are already more likely to continue higher than to continue lower. And that's in general because you're just trading stocks, right? Which historically seen, if we take a look at this, they have just been reaching all-time highs over and over and over. That's the same with gold. It's the same with, well, silver a little bit less, but the same with gold and silver, the metals. Historically, they just tend to continue higher more than they tend to continue lower. When it's almost like this large magnet, this again, literally like gravity. There's just a large magnet sitting right here at the top, and price is consistently reaching towards it. It's literally like gravity. So to sum everything up that we just went over before we move on, how to then actually approach it, you just have a very clear bias oftentimes. Majority of the time, your bias is just buying, looking for a reason to buy again. Now, of course, this isn't always the case, and we'll also dive into scenarios where this isn't the case and how you can approach it. First of all, the thing you want to do is when you take a look at these all-time high instruments, the first thing you want to understand is to not take any shorts. I know how tempting it is. And why is it so tempting? I'm going to explain it from a certain perspective, so it fully makes sense in my eyes at least. So whenever price goes lower on, for example, the indices right here, again, I mentioned, right, let's assume this line is like gravity. It's like the ground as we know it. So whenever you jump, you come back down, right? That's gravity. So it's like it has this pull factor. The same in the indices and these all-time high instruments, they have this pull factor. So they're always trying to continue higher. So whenever they are trying to continue lower instead, they really struggle to. Why? The same, right? I can't jump 10 feet high because I will really struggle to do so because gravity is just pulling me back. So you will notice that most of the time when these all-time high instruments, when they try to actually continue lower, they will struggle a lot more. Relatively seen as to when they try to continue higher. When they try to continue higher, it's just an explosion higher. Again, when we start reaching these all-time highs, oftentimes it's just explosion higher. So when we explode higher, what does that also imply? What does that also mean? And when we really struggle to continue lower right there, what does that also mean? Well, inherently, you'll notice that you have a lot more time to be able to spot that we do want to continue lower, or we might want to continue lower. And you won't have that much time to get involved in the buys before you miss them. So the buys, they play out like boom, high probability, and it's over, if that makes sense. Whereas the shorts, you have, well, a lot of time to think about this, to even overthink it, to get some analysis paralysis, and then you can decide, oh, now I might want to get involved, etc., etc. So inherently, lower probability conditions like these shorts, for example, or for example, even if we zoom in, whilst we are continuing higher, you have a couple of moments, let's say on the 50-minute time frame, where it might seem like we are continuing higher right there. These conditions, they just last longer. So lower probability conditions, they just last longer because of what we went over just with that gravity pull. It's trying to continue lower right there, but it can't do it, so it's struggling, if that makes sense. So gravity is pulling it higher. So inherently, this takes longer to form. And if it takes longer to form, you have more time to spot it, right? If something takes less time to form and it's higher probability, you have less time to spot it, so you have less time to actually profit from it, right? It's important to understand. So majority of the time, what traders are doing is they are actually staring at low probability conditions because those show up most of the time. Because low probability conditions, they just form longer. Whereas high probability conditions, again, it's a click, it's a snap, and it's over, if that makes sense. So with high probability conditions, you need to know what you are waiting for. Otherwise, you're always behind the fact. Otherwise, you're never going to catch it. So again, I'm going on a little bit of a ramble, but I want you to understand those dynamics. So now you understand those dynamics, we're going to move on to how to actually understand what you are waiting for, how to get involved in these moves higher. So we understand, of course, that the bias in all-time high conditions, so when we are just moving higher like this, the bias is not really a problem, right? It's just all-time high after all-time high after all-time high. So the bias is bullish all the time until the higher times are switching. Again, things we'll also dive into. But then what is important to understand is that most of trading, and once you actually get past a certain stage and you understand the bias quite well, and the bias is not really the problem anymore. So that analyst phase, someone is not the problem anymore. It really becomes about timing. So most of the time, traders, they struggle with timing. That's it. And I'm not talking about executing within a specific macro session or a kill zone. Absolutely not. It's not necessary. The chart, the technical analysis will tell you when the time is right to actually enter. So what are we trying to time, right? What are we trying to time? Well, we are essentially just trying to time when momentum is at its peak. And what do I mean by that? Well, when you're looking at this price action right here, which of these moves are the best moves overall? And again, the best moves we're looking to buy, right? Well, what inherently makes a move very good if you are looking to buy? Well, if I'm looking to buy, and the higher we move, the better it is, arguably, right? So a buy is not that great if we don't move higher that much, because we'll probably hit my stop loss right there, something along these lines, before we might continue higher, if that makes sense. So the best moves happen when we just explode higher. Now, of course, then it's all about timing again, because then you could ask yourself, well, when does explosion happen? Again, when momentum is at its peak. That's something we're going to dive into as well. But what I need you to understand, when we have been exploding like this, you're oftentimes too late with entering right now. Same here, when you enter right here and we've just been exploding and now you enter again, you're oftentimes too late. Now, of course, it depends, right? If you're an investor, that's all right, as in we could still continue higher. But as a trader, and if you're using the 50-minute time frame, if you're using the lower time frame, then you need to time the market. Why do you need to time the market? Well, very simply said, if you take a look at this position tool right here, how do you actually make a profit? Well, you make a profit by the market moving from point A right there, your entry, to point B, which is your take profit right there. If it moves to point C, anywhere in the middle before it moves to point B, that's not good, right? Because then you're going to take a loss. So you need to time the market. It's more about timing than anything else, because you need to enter right there and make sure that you have enough conviction right here that's actually going to move in your favor more than it's going to move against you. That's it. And that's arguably the most difficult thing about being a trader, because oftentimes, and you'll see this in your own trading, if you are oftentimes right on the buys, but you get taken out, so it still hits your stop loss and then moves in your favor, you have a timing problem. That's all it is. So how do we go about that timing again? Well, first of all, we need to understand that retracements are actually very good. You want retracements because every retracement in an all-time high market is just another reason to buy again. It's just giving you another reason to look to buy again. Again, look at this, right? Very simply, when was the last time we actually had a retracement or we moved lower and we didn't move higher afterwards? Well, of course, when we continued lower right here. But every single time afterwards, we had a retracement here, retracement here, retracement, 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 even smaller, right, on the lower time frame, retracement, 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 retracement. And every single time we continued higher afterwards. So that's why all-time high instruments are super easy, in my opinion, to trade. And every time we have all-time high instruments, the MMT always has a field day with it because you can just rinse and repeat this. So the bias is clear. We discussed that. Next, we understand we need to time the market. Really quick before we move on, I have quite an interesting offer, which is completely free of charge, by the way. There's nothing on your end. If you are trading with prop firms, then we as ex-prop firm owners, we have built pipback.com, where you essentially get free tools like a complete free prop firm dashboard where you can have all your accounts in one dashboard and you can create a pre-session routine, check out your data, create your journal, everything essentially. And if you're ever looking to buy an evaluation, you can always get the highest available discount if you use our discount code PIP. Check it out, link in the description. We also have an evaluation calculator. We keep track of rule changes within prop firms, for example. So how many rules are changing? We keep track of when there are new discounts, everything for completely free. So if you're a prop firm trader, that's for you. So ideally, these large moves are the best moves, right? Those large expansions where we have large momentum to continue higher. So ideally, we get involved before these large moves happen, right there. That's where we want to get involved because then we can just ride these large moves higher, essentially. That is the goal. Now, how do we go about that? You'll see, again, like we discussed, first, it is important that we create somewhat of a retracement. Now, I like to see these retracements on the 1 hour time frame, oftentimes. And on the 1 hour time frame, you'll notice something. Because on the 1 hour time frame right here, when we create these retracements, we'll oftentimes create bearish fair value gaps right there. Now, that's not the time where you start looking for short and you start being bearish. Again, can you just not look at shorts at all? We'll also discuss that in a little bit. But yes, you can look at shorts, but inherently in a market where this market hasn't created a bearish down candle, and we might in the next candle right there, I might jinx this and we just create another bearish large down candle. I might be the start right here of a bearish market. Anyway, we haven't created a down candle since March. We're almost halfway through May. So when you are looking at shorts, you don't have a whole lot of price action supporting your ID. So the first thing you just want to do is understanding that you shouldn't be taking a look at shorts right here. Okay. On the 1 hour, what you're going to see is these bearish value gaps. Don't look at shorts, not just yet until the higher time frame starts shifting as well. And all you're going to do, and all you are essentially waiting for, is for these bearish fair value gaps to be overtaken, to be disrespected, to then continue higher again. Because when do we continue higher? When there's nothing preventing us from continuing higher anymore. That's it, right? If there's nothing preventing us from continuing higher, we have a very easy time to continue higher. So what are things that are preventing us from continuing higher? Well, resistance areas, right? This fair value gap is a resistance area. We might want to continue lower from it. But if we don't continue lower from it, what are we going to do instead? We're going to continue higher right there because this thing is not preventing us from continuing higher anymore. So instead, we just explode higher. And this is the pattern that you will see a lot. It happens very often. Fair value gaps right here that we eventually overtake. Fair value gaps here as well that we overtake. Fair value gaps here, fair value gaps here, fair value gaps here, fair value gaps here, right there, and fair value gaps. And it just repeats itself. Now, what is important to understand before we actually take a look at these fair value gaps as well, what I just mentioned about when you buy, what is the easiest thing or what is the best thing to happen? That we just explode higher, right? So the stronger an instrument, the more it moves higher, the better it is for your buy. The same, if you're looking for shorts, the more it moves lower, the better it is for selling, right? Why is that? Because it will just move more in your favor. And if it moves more in your favor, you have a higher chance that it will hit your take profit. As simple as that. So what is important is that, for example, you'll see I have this list right here. Now, when I take a look at which one I'm going to trade, the thing I'm going to pay attention to is which one of these instruments is actually stronger, which one is weaker. So for example, if we compare ES to NASDAQ, we see NASDAQ is stronger. Why? It has been moving higher more. The retracements are simply smaller. That's it. It's as simple as that. If we compare that, both of those to YM, for example, we see YM hasn't been moving as high as an ES and NASDAQ, isn't even close to all-time highs at this moment in time. Well, it's quite close, but it's not as close as an ES or NASDAQ. So inherently, YM right here is weaker than NASDAQ and weaker than ES. So if you were to rank these, you could argue NASDAQ right here is actually the strongest. ES is the second strongest, is in the middle. It's not that weak, it's also not that strong. YM is actually the weakest. So we have 1, 2, 3. So what is important right here is that if you take a look at these and you understand which one is weaker, which one is stronger, then you also understand which one you are waiting for. So in the scenario where you are waiting for the market to continue higher, the indices in general, they move in correlation, they move together. So if they are all going to continue higher, so that means they're likely, if they continue higher, they all continue higher, if that makes sense. But depending on which one is stronger, that one is going to move higher the most. So for example, NASDAQ, we understand this one moves higher the most right there. So if we are looking to buy, we want to ideally buy NASDAQ there because again, it's the strongest, it's going to move higher the most. If we are, well, selling or buying, ES is not really that interesting unless ES overtakes NASDAQ from a day-to-day perspective and ES is all of a sudden stronger than NASDAQ. If we are looking to short, so actually the market is going to continue lower, we already understand YM was the weakest, right? So YM is the one we're going to pay attention to if we are actually going to continue lower as a whole, as the market, because then this one will most likely drop off more than, for example, NASDAQ and ES because those are stronger. It's that simple. So oftentimes the trader that has a lot of fancy concepts, etc., that is still buying simply the weaker instrument is still going to lose more than the trader that doesn't know anything and is just simply at all times buying the strong instrument. That's it. It's quite straightforward. So once you have determined that, okay, now we understand we're looking at NASDAQ to buy if the market is going to continue lower. We're looking at YM to sell. Perfect. So we now wait for a retracement. And a retracement, ideally for myself, that's oftentimes on the 1 hour right there. Now, there might be a time where eventually we're also going to create a larger retracement, let's say a 4-hour value gap. There might even be a time where we create a daily retracement like we saw with previous all-time high protocols right there. It's essentially zooming out and seeing on which time frame is this retracement actually happening. That's the most important part. And you'll see most of the time right here, that's on the 1 hour. But if the retracement is larger right there, zoom out to the 4-hour or the daily and see if we can overtake that to continue higher again. Next, what you want to identify is the range that you are working with. So for example, in this scenario right here, this is the range, right? This is essentially the new all-time high right there. So all we're doing is looking for a reason to buy again, and we're looking to buy towards that all-time high. How do we do that? Well, right here, we see that we have this bearish fair value gap right there. This bearish value gap is, like we mentioned, a resistance. If this bearish value gap is holding, so something along these lines, and we actually continue lower from it right there, we don't do anything. But if this bearish value gap is not holding and it's actually being disrespected, that's where we'll look to buy, because then nothing is preventing us from continuing higher anymore. How do we understand when this bearish value gap is actually being disrespected? Well, as many gurus and creators might want you to believe that fair value gaps have all these different levels, 75%, etc., these random Fibonacci levels that don't really matter, that we can reject from, I'm going to tell you, a fair value gap or any resistance and support level, any PD rate in general, we can only reject from it once. If we don't reject from it anymore, we are rejecting from it from something else in order to keep your accuracy. Otherwise, you're just going to lose your accuracy. So right here, this bearish fair value gap right there, we are currently rejecting from it. It's oftentimes within, if you're looking at the same time frame, it's in that same candle. So the first candle or the second candle oftentimes, what I refer to as 2-candle rejection. Now on the 15-minute right here, you'll see this oftentimes a little bit more clearly. So all the rejection is just a movement lower, right? It's trying to reject away from the fair value gap right here. So this leaves us with a rejection high. This is that rejection high right here. So on the 1 hour, it would be this one, right? This is where right now, if we are going to continue lower, we should not trade above this high, or at least we should not run that rejection high. So we should just either sweep it or just continue lower immediately right here and just keep rejecting from the fair value gap. Now, instead, what we see is that we climb above the rejection high right there. If we are running that rejection high, and how do we know if we are running that rejection high? Quite simple, because oftentimes it's just a formation like this. So we sting above it. It's what I call two sting, where the first sting right there, we create a retracement and we create a second sting right there. So here you'll actually see that, and you can see that fractally. You can also go a little bit lower if you need to. Here you'll see the first sting. This candle was a first sting, right, above that rejection high. Here we now, in this wick, that's a retracement. So what is happening in this candle? It climbed above, and then we create a retracement. This wick at the bottom is a further retracement. So this is what happened in these two candles. Afterwards, it was an up candle again. So this is now what happens right here. So we're seeing one sting, two sting. When we have one sting and two sting right here, this right now is disrespecting the fair value gap that we had right there. So eventually right here, this is now very interesting to continue higher and target a new all-time high. Again, what is the goal of this? What are we doing essentially here? And let's grab another example as well. Well, the goal of this is timing, like we mentioned, right? So we are trying to get involved before these large expansions happen. This is essentially what we're trying to be a part of. And the reason why that is again, that whole from moving from point A to point B story, right? We're trying to catch this move towards a take profit. What is important is that you're essentially filtering out a retracement. That's it. That's how you time the market correctly. So what I mean by that is, well, literally as I say it, you are filtering out a retracement. And let that sink in a little bit. Think about that for a while. That's all you're doing. The moment we can't retrace back to your stop loss anymore is the moment it's very interesting to now enter, because that's where we'll likely reach your take profit. So what I mean by that is, for example, this is all the all-time high protocol essentially comes down to. We create another retracement right here. Perfect. So this all-time high is going to eventually be our new target. Again, we don't immediately look to get involved from a random fair value gap right there or anything like that. No. You wait. You wait until the momentum is in your favor. So here, we actually see that we have this rejection high at first. Now that rejection high is being swept. So we're sweeping that rejection high. So we are rejecting from that rejection high. It's like the inception. We're not running it. Perfect. So we can use this high right there as a new to then understand what we are actually looking at again. Here we see that same two sting. So we see the first sting, we create a retracement, and we create a second sting right there as well. So again, that same formation from that rejection high along these lines right here. And what we're doing is at first, because if you enter like this right here, and you say, oh, I need to get involved right here because now we could potentially continue higher. And oftentimes what might happen is that it hits your stop loss before we actually continue higher. It's a timing problem. And because you didn't filter out the retracement just yet. So here, we are still rejecting from this rejection high, which is a swing high as well. If we now stop rejecting from this rejection high right there, eventually we are again more free to move. So right now, this is a very good entry right here on the 1 hour time frame right there. Now, of course, I imagine that some might not want to use the 1 hour right here. So you might want to go into the 15-minute time frame. Well, from the 15-minute time frame, this essentially works the exact same, right? So here you create a retracement. You're just part of the same move, in all honesty. It's just you have a more refined entry right here. That's all you're doing. Now, if you are a scalper, so as I like to refer to it, a flow trader, where you use the 1 minute to get involved, then you want to approach this a little bit differently, which we're going to dive into as well. So right here, this is how you would get involved on, for example, a 1 hour, 15-minute perspective. Now, how do you get involved from a scalping perspective? You ideally want to refine that overall range that we saw right here, that we just did on the 1 hour, now to the 15-minute as well. On the 15-minute, you might see, for example, that you have this fair value area, order block, breaker block, whatever you want to call it. That's something that we can reject from. So again, that's a resistance area, right? That's what we see right here. So we have a similar scenario. So we are rejecting from this PD ray right here. Now we have this rejection high, which is again that rejection from that PD ray. We see another candle that creates another rejection right here. Perfect. So what are you looking at? If you were to zoom in like this actually, and you were to actually remove the time frames and you were to just look at this as a whole, wouldn't you argue that you have the exact same thing as what we were just looking at on the 1 hour time frame? It's just fractal, right? It's just the exact same thing. The thing about this though is because you are using the 1 minute to now look for an entry, you can't just enter randomly right here, because if you enter randomly, for example, right there on the 1 minute time frame, and you put your stop loss anywhere, again, you're most likely just going to time the market incorrectly. So you're going to take a stop loss right there before we actually continue higher. So you want to wait for a lower time frame range within the higher time frame range that you are using. So what I mean by that is this 1 hour range is the 1 hour range, right? That we understand. We are disrespecting this fair value gap to continue higher. We have quite a free path right now to continue higher towards the all-time high again. Then we want to do the same thing from another PD ray right there, and where we create another range on the lower time frame. So this again is another range. Now we get involved right here the moment we see the exact same thing on these lower time frames. So for example, right here, we have these fair value gaps, we have these fair value areas, as I like to call it, but again, or block, whatever you want to call it. You also have these swing highs right here. The moment we now start disrespecting these fair value gaps, these fair value areas, these swing highs right there, is where we are now looking to target these highs. So here, for example, now we are creating the rejection high again. Here, this is where you can be a little bit more aggressive because you're doing everything on one time frame, if that makes sense. So if we start thinking above these highs right there, is where we have a very clear path to continue higher towards these next highs that we see. Let's see, right there. So essentially what you are doing as a whole right here is you're just filtering out the retracement. And that's the most important part. So you don't get involved here, right here, and then covering these lows, for example, because now, again, you're always, important to understand for your trading, your best trades will always happen in between highs and lows, and that's fractal. So that's time frames. So for example, right here, this right here is where your best trades will happen. If you're looking to buy here. You don't buy here. It's where the expansion has most likely already happened. The next thing that's most likely going to happen is a retracement, actually. So you don't buy here. You buy, again, same right now, we're in between highs and lows. That's where you buy right there. It's important to understand. So here, this is not where you buy. You wait for, again, a retracement, a range, the same thing that you looked at on the higher time frame. Right now, can we overtake those to then continue higher? Then you enter, for example, along these lines, covering those lows to now continue higher, because now you filtered out that retracement successfully, if that makes sense. And now you can actually target that 1 to 2 RR to actually continue higher, if that makes sense. And that's very important to understand. Now, the reason why this is arguably a little bit more difficult at scalping is because you have more variables, right? So I needed to go into lower time frame range within that higher time frame range. Then the main target is this high, yes, but the main target above it is still this high, right? Because we're still trading within this range overall. So you're working with multiple ranges within ranges. So there's just more variables at play, which is harder at start to understand. But here, for example, same thing. Now we are creating this rejection right there. If we can overtake that rejection and continue higher again, it's the same thing. Every retracement gives you an opportunity right there to get involved. The moment we now have a new all-time high, you wait. You don't do anything anymore. You wait and sit back until we again create a larger retracement. Well, here on NASDAQ, actually, it's already this retracement right there. And that retracement, a new opportunity to look to get involved. Every time we create a retracement, it is a new reason, a new opportunity to look to get involved. The only way this will truly make sense is if you study it. Now, we're also going to move on a little bit right here, because what I think is important to understand as well is, of course, we're not always going to have all-time high protocols, and we are also going to have moments of retracements or where we just drop off heavily. Now, the way that happens is, for example, if we now actually start to drop off heavily, and instead of continuing higher again, we start to disrespect fair value gaps. So we keep trading through fair value gaps. So let's actually look at a previous example to show you what I mean. Here we see that we now keep trading through these bullish fair value gaps, and we keep dropping off. We keep dropping off. So we don't actually continue higher towards a new all-time high. If that happens on a 4-hour time frame, that also starts happening on the daily time frame. So the higher the time frame that that's actually happening on, also disrespecting these bullish values right there, then what is happening is that slowly the higher time frame is switching. And when slowly the higher time frame is switching, that's when you can also start looking, or when shorts are at least higher probability. Now, of course, for example, right here, we see a couple of drop-offs here and here. At this moment in time, you don't look for shorts immediately. No, you wait. Because you first want to see if we actually follow through. So the follow through is important. If we reach below this low again, or if we now disrespect this value gap to then continue higher again instead. That's important. Here we just disrespect this value gap to continue higher again. So again, it's just the all-time high protocol. In the scenario where you start looking for shorts, it's pretty much the same thing, right? Because all-time high protocol is all-time high protocol, but it's just all-time high protocol because we are reaching all-time highs. Because you could invert it and say, if you're looking at shorts, it's the same exact protocol. All it comes down to is you have a clear bias, you have a retracement, and you look to get involved. So for example, right here on gold, at this moment in time, I was bearish on the higher time frame. So we were running a couple of lows right there. And at that moment in time, I was bearish. So right here, we see that we actually create, in favor of my bearish bias, we create this retracement right here. Perfect. Now I have this range to work with, right? So I can target this low. So the moment we start disrespecting this bullish fair value area, right there, which is running this rejection low, that's where I get involved. So on the 15-minute right here, we see that we actually start stinging below it. Let's see. We have a very large sting. That's where it is. And where do I now get involved? Well, I refine to another range right here. So we now have this fair value gap that's preventing us from continuing lower. If we now run this rejection lower right there, it's pretty much the exact same thing to continue lower right there. And this is eventually where I saw this twisting right here. So with this candle, that wick is that retracement that we see. So what is happening on the lower time frame? Essentially first thing, second thing right there. And this is where I got involved right here. To continue lower, targeting simply a 1 to 2 RR, which is basically the exact same thing. If I invert this chart, you wouldn't even be able to tell the difference. Let's see right here. As far as I'm aware, this might be the all-time high, right? Inverted chart. It's the exact same thing as what we were just looking at. Exact same thing. And you can absolutely, once you start understanding this, you can rinse and repeat this. And you'll make a whole lot of profit. The only time where you'll start losing maybe one trade is towards the end, for example. Now, of course, I'm not saying that this is perfect and going to work every single time. You might take a loss, for example, right here as well. But the winners will far outweigh the amount of losses that you take. So what would you do right now on NASDAQ? Well, wait for a retracement. Because if we get a retracement and we get another reason to buy right there to continue higher, perfect. If we just drop off right there as a whole, perfect. Might take a look at the weakest instrument at YM instead to target some lows, target those lows right there, if that makes sense. So either way, you're going to be fine. Again, if you are using prop firms, check out pitback.com. It's completely free. You always get the highest available discounts even. We have a free prop firm dashboard that you can use, again, all for free, where you can journal, create a pre-session routine, link in the description.